The natural gas prices we're seeing in heating bill increases is a reflection of some of that tension in the eastern part of Europe.
Welcome back. I'm Natalie Nanowski, and this is the Midweek Exchange. We're going to break down those big economic issues that could be affecting you. As always, to help me with all of that, I'm joined by Brett House, Scotiabank's VP and Deputy Chief Economist. Hi, Brett. How are you doing today?
Hi, Natalie. Can you believe we're already in February and have a month of 2022 under our belts?
I really can't. And I do want to talk to you about that first month because a lot of people saw high prices at the pump and on their heating bills. So, natural gas and gasoline affecting households there. What's going on with that?
Well, energy prices continue to be one of the two biggest contributors to our high headline inflation rates, and gasoline and natural gas are leading the way. On the oil front, we're continuing to see supply fail to keep up with the increased demand for gasoline and other oil products that is coming along with the continued reopening of major economies. On the natural gas front, we've got an additional pressure owing to the conflict between Russia and Ukraine. A lot of natural gas is supplied to Europe from Russia, and there are concerns that either demand for that gas will be shut off by governments or supply will be constrained in an effort to pressure Europe. That means natural gas prices have been pushed up globally as some supply from the rest of the world is diverted to Europe. So the natural gas prices we're seeing in heating bill increases is a reflection of some of that tension in the eastern part of Europe.
Right, and it doesn't help that we're experiencing a colder winter than usual in some parts of the country. And so, how do these price pressures connect to the dips that we're seeing in the stock market? Because right now, households are seeing their bills go up, but they're also seeing their investments dip.
Well, you're right to connect the two, Natalie, because the swoon we saw in major equity indices in January, in many cases recording the second worst first month of the year that they've ever seen, is tightly connected to what we're seeing on inflation. Because over the last few weeks, we've seen central banks like the Fed in the US and the Bank of Canada indicate they're going to be imminently moving to raise their key policy rates. And typically, when that happens, equity investors get concerned that it will dent consumer and household and business demand and make it harder for businesses to finance themselves. But if we look at the last 40 years of central bank rate increases, after a small dip in stock markets, typically by about 6 months out, those equity indices have recovered and are up. Because ultimately, the increase in interest rates being promised by central banks is a vote of confidence in our economies. And it's a sign that, some of our best economic analysts don't think businesses and households need continued emergency support. They're ready to, act and continue growing without those incredibly low rates.
In 6 months from now, it's going to be interesting to look back and also take note of how far we've come. And in terms of the next week, what can we expect there?
Well, on Friday, February 4th, this week, we end up getting the January labor market numbers for Canada. And those are going to be interesting to see how much of a dent Omicron put into the continued jobs recovery in Canada. We think it'll be observable, but small, and won't knock the Bank of Canada off from increasing its policy rate at its March meeting.
Great. Thanks so much, Brett.
Great to talk with you.
Great to speak with you too. And the Midweek Exchange will return next Wednesday.